guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, we will discuss these 4 dividend ETFs that could crush SCHD by 2030. Is SCHD's reign as a top dividend ETF sustainable, or will new contenders rise to the challenge? Well, SCHD has been on a remarkable winning streak, and it has a strong track record with a 13.5% average annual return and outperformance compared to the S&P 500. While SCHD or Schwab US Dividend Equity ETF has been a popular choice among dividend ETF investors, claiming it to be the undisputed king would be subjective and dependent on individual preferences and investment goals. However, it is possible that there are other ETFs that have the potential to challenge SCHD's dominance in the future. It will be interesting to explore the 4 exciting ETFs. Stick around till the end and you'll discover investment ideas, strategies, and the best accounts to maximize your returns, accelerating your path to financial freedom. Let's start with an intriguing question. Why might the Vanguard High Dividend Yield ETF outperform SCHD in the long run? Brace yourself for a journey filled with financial wit and charm. Here's the first out of 4 dividend ETFs, BYM, the Vanguard High Dividend Yield ETF. It tracks the FTSE Dividend Yield Index, selecting high-yield dividend-paying U.S. companies excluding REITs. With low fees, diversified holdings of more than 440 companies, and leading sectors like finance and healthcare, BYM is a star. Noteworthy features: a tiny expense ratio of 0.06%, an impressive 11.6% average annual appreciation over a decade, and nearly 3% dividend yield. Plus, it's been more resilient than SCHD, with just a 2.8% dip in the past year. In essence, BYM shines as a reliable and sustainable option for long-term dividend investments. Raise your imaginary glasses to the Vanguard High Dividend Yield ETF and let its enduring charm grace your portfolio. Moving on to the second ETF, an ETF that has been causing quite a stir in recent times. Prepare to have your mind blown by the astonishing JEPI, also known as the JP Morgan Equity Premium Income ETF. JEPI has been making waves due to its impressive 12.39% dividend yield. While this is significantly higher than most dividend funds, it's important to understand how JPEI achieves such high dividends. JPEI uses an ELN structure to write covered call options on the S&P 500, allowing for profit distribution to investors. However, the lack of transparency raises concerns, and it's advisable to include JPEI as part of a diversified dividend portfolio. Despite having a higher fee of 0.35%, JPEI's high dividend yield compensates for the cost. With an annual return of over 13% since its inception and a current price just above $55 per share, JPEI is worth considering but requires further research. In summary, JPEI offers a unique opportunity with its high dividend yield, but investors should carefully evaluate its strategy and consider it within a diversified portfolio. How can JPEI produce such a high dividend yield? Uncovering the mystery behind JPEI's high dividend yield. JPEI's high dividend yield can be attributed to its utilization of an ELN structure to write covered call options on the S&P 500. This strategy allows for the distribution of profits to investors. However, the lack of transparency surrounding JPEI raises concerns. It is common for investors to include JPEI as part of a diversified dividend portfolio, considering the higher risk associated with options involvement. It's worth noting that JPEI has a limited history since its inception in 2020. Before making any investment decisions, conducting thorough research and analysis is crucial. High fee but even higher dividend yield. Despite JPEI having a higher fee compared to passive funds like VU or SCHD due to active management, its dividend yield is even higher. While the expense ratio stands at 0.35%, the substantial dividend offered compensates for the cost. If JPEI can consistently maintain a dividend above the 12% range, it presents an attractive opportunity. Although it lacks a 10-year track record, the available data since its inception shows an impressive annual return of over 13%. With its current price just above 55% per share and a 10.5% decline over the past year, JPEI is worth considering, but further research is advised. Moving on to the third one, let's talk about DGRO, which offers an exciting strategy that many analysts prefer over SCHD. This fund tracks the U.S. Dividend Growth Index from Morningstar, a dividend dollar-weighted index designed to measure the performance of U.S. companies with a consistent history of growing dividends. What sets DGRO apart is its inclusion of small, medium, and large-cap companies, adding diversity to your portfolio compared to the funds that focus solely on large caps. One aspect that is admirable about this fund is its stock selection methodology. DGRO screens for 5 years of uninterrupted annual dividend growth, identifying a universe of dividend growers. It also looks for companies that pay out dividends not exceeding 75% of earnings, targeting those likely to sustain dividend growth. Additionally, DGRO avoids companies with dividend yields in the top 10% of the investment universe, reducing exposure to unsustainably high yields. While this last criterion can be seen as both positive and negative, overall, DGRO presents a compelling investment opportunity. It combines a dividend growth strategy with diversified holdings across different market caps. Now, let's address a couple of points. DGRO has the potential for long-term growth due to companies like Microsoft and Apple. It holds stocks in healthcare, financials, and information technology, where it has a low expense ratio and has delivered a 10% average annual return since 2014. It has a relatively low dividend yield of 2.27% and excludes high dividend yielding stocks. So consider DGRO as part of your portfolio, not as your sole investment, considering its lower dividend yield and exclusion criteria. The fourth or the last ETF we have here is the SPDR Portfolio S&P 500 High Dividend ETF, or SPYD, which stands out for its sustainable high dividend yield and careful company selection. SPYD focuses on the top 80 companies with the highest dividend yields in the S&P 500, which are considered solid and relatively safe investments. The fund's largest industry holdings include financials, utilities, real estate, energy, and consumer staples. Since its inception in 2015, SPYD has achieved an average annual return of almost 9%, with an expense ratio of only 0.07%. With a current price of $41.58 per share and a dividend yield of over 5%, SPYD offers a compelling opportunity for investors seeking both income and potential growth. It strikes a balance between high-yield companies and those with strong growth potential. Despite experiencing a decline of almost 6% over the past year, SPYD has the potential to generate consistent cash flow and is positioned as a sustainable long-term investment option. However, it's important to note that while SPYD's high dividend yield and low expense ratio make it an attractive choice, it should still be considered as part of a diversified portfolio rather than comprising the entirety of your investments. When selecting a dividend ETF, it is crucial to carefully analyze the fund's historical performance, expense ratio, diversification, and dividend yield to ensure it aligns with your investment goals. Now, as you explore potential dividend ETFs, ask yourself, which factors matter most to me, and which ETF best suits my long-term investment strategy? Well, that's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.